If you go back to the 1900s when we were basically on a silver standard in the world, yeah, gold played a role, but really the world's been more of a silver standard in recent history, going back 125 years, than the gold, although they both are there. But you would have to look at, what an average wage was and how much silver was available versus the population. And what you would find if you did that arithmetic, you'd have to be somewhere at the $200, $250 an ounce level in silver in today's fiat price to be anything close to the real wages back in those days. But what's interesting is the population increased from then till now and how much silver's increased from then that's available. And you would find that if you went back on a silver standard, you couldn't probably do it at that price. So my point is that even though there's a contingency within the silver followers, investors, traders, I don't mean traders, but traders that say, silver isn't money, it's just industrial, blah, 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 blah. And, I'm not going to argue. I mean, the word silver and the word money are synonymous in 14 languages, but that to the side, the market determines what it is, and the margin is buying it for investment purposes. Yeah. And that's what the world has woken up to, is that, wait a minute, this is almost, or maybe better than, a store of value and a safe haven than gold is, especially because it's more affordable to the general populace. And now it's a worldwide market, not just the Hunt brothers and a few sheikhs like it was in 1980. So now we have a situation where the general public that's waking up more and more every day to the reality of a fiat fiasco in all currencies, not just the US dollar. Every currency is touched by it. And what can I do about it? Well, gold's at, 5,000 per ounce. Well, maybe I'll put 5,000 in the silver. It's a lot more divisible. I get a lot more units for the same amount of fiat. And it's proven through history to be just as good a safe haven as gold in most cases. So yes, the silver market is definitely coming into the fore as one of, I'll call it the stars, and I'm biased, for the end game, which means we get to find out, my favorite expression, who's who in the zoo. Who's real and who isn't? Who has the 1,000-ounce bars to deliver and who can't deliver? How much demand is there physically in the industrial world, and how much investment demand is there physically in the real world? With those two combinations and a synergistic effect of one leapfrogging the other, I have to have it to keep my business going. So I'll buy silver at any price, more or less. And the investment demand that still is very undervalued relative to gold, because the gold silver ratio isn't even close to the recent high going back to, I think, 2011. And that was about 30 to 1. And now we're about, I don't know, today's price, probably 60 to 1. So double that. So I expect silver to at least get to that level of gold silver, which means silver would double from here with gold being static. So you could say silver would be 160 while gold's still around 5,000, rough numbers. Well, if you go back to the beginning, in like the year 2000, there weren't many people covering the silver market. Basically, from the best I could determine, there were two. There was myself and Ted Butler. And then many, some came on board. I mean, Ed Steer has been a long-term silver bug and very analytical. And, Ed and I are friends, and he does a great reporting, more in depth on the daily moves than I do by far. The point being that there's a lot of Johnny-comes-latelys that don't understand it. But you asked a question, let me get direct to it. Why? The why is, I said, and Ted said, and others from the get-go, that there would come a day where the physical market took command of the pricing mechanism, not the paper markets, not the paper paradigm. And that is taking place as we speak. And it really took hold, and it's happened from time to time. There's been times where the retail investor bought enough silver, the market got really tight. In fact, it was so tight, it was hard to deliver in a retail product. But it's really never happened substantially in the silver market. The silver market is the commercial bar market. And that physical market, these 1,000-ounce bars, when that gets in tight supply, now you're going to see real price discovery. And that's what took place for the last few months. And we got the big move in 2025, about 140% gain year over year, which is pretty phenomenal, about double what gold did over that year. And then in January alone, we went up about 70%. And I was warning both my private work, my premium members, and the general public, look out. I don't care what it is, soybean oil, cocoa, or silver, that kind of a move is going to come down and come down hard. Be careful. I'm probably one of the first to document it thoroughly. I don't know if thoroughly is the right word, as thoroughly as I could at the time. When I wrote the Silver Manifesto, I wrote pretty much a whole chapter, chapter 6, Intervention, Induced Price Suppression in Silver and Gold. And I cannot read you the whole thing, Maggie, but I mean, it's in the record. The problem with the Silver Manifesto is that every silver well, of course, I'm selling my own book. You're paying me probably 2 cents per hour of the amount of effort as far as hours and the price of the book. Anyway, I digress. I went through so much of how this whole thing works on a fractional reserve system that it could break using the Sharpe's ratio, which you can look up. It's SHARPE. It is used to find if you have a random walk or not. In other words, if a market is manipulated or not. When you do that analysis, what you find is the random walk is so non-random that the Sharpe's ratio is greater than Bernie Madoff. So if that doesn't sum up in a couple of sentences of what's going on in the quote unquote manipulation realm or not. Now, there are many people that will play legal and say, well, the word manipulation never came into the court here, and they didn't. I think it's deliberate, but I don't want to play a semantics game. They were fined JP Morgan's fined $920 million for spoofing. Spoofing is manipulation. Now, if you want to, again, play legal and say, well, spoofing is manipulation, all the markets do it. And most of the markets do it, but not to the degree that it's done in the silver market, not with the frequency that it's done in the silver market, and not with, let's say, the open secret that if you actually take an objective look at it, which I did in the book, The Silver Manifesto, you can come out with a pretty clear understanding that the banks do manipulate the market. Now, I have to say one thing and say it very loud, very proud, and very clearly. I have said from the beginning that you cannot manipulate the long-term trend. That is the ultimate truth. Because if you could manipulate the ultimate trend, the long-term trend, we could still be at $5 silver for an example. But within that trend, there are a lot of not a new word, but a word being used today quite often, shenanigans going on in both the gold and silver markets, and particularly the silver market. So I hope that summed it up. Yeah. I've been getting a lot of trolls. I said that the rollover into March would not cause a default. It hasn't, so I could puff out my chest to see I'm right. And in a way, I'm correct. But having a more objective, holistic 40,000-foot view, I must take into account what happened yesterday while I was on an interview, that basically there was another problem with the CME and the market was halted for a while. During the halt, it's very much suspect that a lot of contracts were settled over the counter, and then the market reopened and the price of silver fell off, and it's off again today. Hopefully that was clear. It's clear to me, but sometimes I always try to put it in plain English and make it as succinct as possible. But, it's my field. And so what's in my head is common knowledge, may not be so. So it was a classic short squeeze where the longs, the people that were buying silver on paper. Now, a lot of, physical stuff was going on at the same time, especially in the Shanghai market. But the paper market is what determines the price still. So there were more and more contracts being bought. And the people on the other side, because all orders have to match, for every long there's a short, were getting killed. And they were like, they were sweating. And the market just kept going higher. But these guys are savvy because they're both long and short at the same time. They're net short, meaning there's more short contracts that they have than long, but they have them both. The algorithms are very good at mitigating the damage to the short side. And what they do at the end, and I've witnessed this a few times because this has happened not to the level it's happened now, Maggie, but it has happened before. It happened in 2011. I called the top there. Happened in 1980. I wasn't writing a financial newsletter in those days, but I called it the $21 top. Called every top so far. Anyway, the point is that the real smart traders, the spoofers, if you will, what they'll do as it gets way away from them is they'll just stand aside and let free market forces take over. So in other words, they put their hands in their pockets. They don't go long or short. They keep the positions they have and they wait for the actual market to take over. And then when that happens, the market continues higher or lower. It continued higher due to a short that was going against the longs in the Asian markets, and it finally exhausted.